If bad personal credit is stopping your business from getting approved for funding, there is a company right now saying that your personal FICO score may not matter nearly as much as you think. In fact, Revolut has promoted business funding of up to $500,000 even for business owners with bad personal credit. And get this, you can apply without a hard pull on your personal credit report and no PG. But here's the thing, just because your credit score may not stop you from, getting approved does not mean that everybody's going to qualify. It definitely does not mean that everybody's getting 500K, and it doesn't necessarily mean that you should accept the funding just because they approve you. Because once you understand how this product actually works, how much it can cost, and how the repayments may affect your business every single day, the conversation changes completely. So in this video, I'm going to show you who could realistically qualify for revenue with, bad personal credit, how much funding you may actually receive, the real reason they can approve people that traditional banks might turn down, and the catch you need to understand before accepting any offer. And listen, I'm not just reading the website here. I personally applied for revenue. I was approved, and I have the card and the flex line myself. I've spoken with other approved business owners, and I want to give you the full picture here, not just the parts that sound good. But real quick, before we go any further, this video is sponsored by Revolut, but they know that I'm going to give you my honest opinion, including what I like, what I don't like, and who I honestly think should probably avoid this type of funding just altogether. So first, let's answer the biggest question. Can you really get approved for revenue with bad personal credit? And the answer appears to be yes. Revenue openly says that its FlexLine and business card can help businesses access capital despite the owner's credit score. They look beyond your personal FICO score and place, much more weight on the performance of the actual business. Revolut even has a customer story on its website about a business owner named Cody who owns Serve Pest Solutions. According to Revolut, Cody's personal credit has taken some hits, and that made traditional lenders unreliable for him. But because his business was established and generating revenue, he was able to get approved for the Revenue Flex line and use the money for marketing and equipment and cash flow needs. Now, I want to be very clear about what that does and does not prove, right? Revenue does not tell us Cody's exact personal credit score. They also don't tell us exactly how much they were approved for. So I can't sit here and tell you that somebody with a 520 credit score got approved for 500K. I have not found that data point yet, and I'm not going to pretend that I did. What we can say though is that Revenue has approved at least one named business owner whose personal credit has been damaged enough that traditional financing had become difficult. And Revenue specifically positions this product for businesses whose owners may have subprime or challenged personal credit. So the bad credit angle is legit. But here's where I think people can get confused. Bad personal credit may be acceptable. A weak business is not necessarily acceptable. This is not a product where you have a 500 credit score, no business revenue, no business bank account, and Revenue just hands you 500K because you have an EIN number. That's not how this works. The reason Revenue may be willing to look past your personal credit score is because they're looking much more closely at your financial activity inside your business. Now, right now, Revenue generally wants to see that you have been operating for at least 1 year. You need a separate business checking account. You generally need at least $20,000 per month in business deposits. And the business normally needs to be structured as something like an LLC, a corporation, or a partnership, not a sole proprietorship. They're going to look at the consistency of your deposits, the overall health of the bank account that you have, your cash flow patterns, and whether the business can realistically support the repayments. So really, this is not bad credit and no revenue funding. It's really closer to, bad personal credit, but a real operating business with real revenue. And I think that's the major distinction, because a lot of people are going to click on this video thinking, the personal credit requirement has simply just disappeared. It hasn't disappeared as much as it's been replaced. Right? Instead of relying primarily on your personal FICO score, Revenue is relying more heavily on your business revenue and banking activity. Now let's talk about the 500K, because this is probably the part that, got most people to click on this video. Can Revenue provide up to 500K in business funding? That is an amount Revenue has publicly promoted, but up to 500K is the maximum advertised amount. It's not a promise, it's not a guaranteed starting limit, and it's definitely not what every applicant should expect to receive. So let me give you two real examples. When I personally applied for Revenue, my business was generating enough revenue to meet the qualifications. I connected my business checking account through Plaid. I submitted the requested documents. I completed the verification process and I received my decision. And my starting limit was $5,000. Now, $5,000 obviously is nowhere near $500,000, but my account manager explained that Revenue looks at the account as more of a growing relationship. Your available funding may increase over time based on business performance, your revenue, usage, and repayment history. I also had one of my community members, Charles, get approved for about $40,000. So now we have my $5,000 starting limit. We have a community member at about $40,000. And then we have the advertised maximum of $500,000. Now, could a large established business with strong deposits receive a six-figure approval? Yeah, sure. That appears to be possible. Should the average person watching this expect to apply and then immediately receive 500K? Absolutely not. The amount is going to depend on how much money is moving through the business, how consistent that revenue is, the health of the bank account, and Revenue's overall underwriting review. And honestly, I think the amount of money that you're approved for is not even the most important number. The most important numbers are going to be the factor rate, the total repayment amount, and how frequently the payments are coming out of your business checking account. Because Revenue is not a normal business credit card or a traditional bank line of credit. Revenue describes the flex line funding as the purchase of future receivables. It's a revenue-based financing, not a traditional loan with a normal APR and monthly minimum payments. And that's important because you're not necessarily going to receive an interest rate like 12%, 18, 25%. You may receive something called a factor rate. For example, the community member I mentioned was approved for, that $40,000 with a 1.44 factor rate and daily repayments. Now, he personally did not like those terms, right? And once you run the numbers, you can understand why. So let's say, just for a simple example, that somebody drew the full $40,000 under that 1.44 factor rate. You would multiply $40,000 by 1.44, and that would produce a total repayment of $57,600. Now, that means the cost of accessing that $40,000 will be $17,600. Again, that's a simplified illustration based on drawing the full amount, your actual agreement, your draws or repayment schedule, and any available early payoff terms will control the real cost. But here is where a lot of business owners make a mistake. They see a 1.44 factor rate and think, okay, so I'm paying 44%. But listen, a factor rate is not the same thing as 44% annual percentage rates. If that entire amount is being repaid over a relatively short period and the money is coming out of your account daily, you're paying the principal back almost immediately while still paying the full financing charge attached to the draw. That can make the effective annual cost of the money dramatically higher than the factor rate first makes it sound. And this is why I keep saying that the repayment schedule can be more important than the approval amount, because everybody wants to talk about how much money that they can get. Can I get 40K? Can I get 100K? But the better question is, how much money is going to leave my account every single day after I accept it? Because your business could get approved for a large amount of money and still end up in a worse financial position if those repayments begin, draining your operating cash before the money has had time to produce a return. And that's really the catch here. The fact that there's no hard pull is valuable, sure. The fact that bad personal credit may not automatically disqualify you is valuable. The fact that there, is generally no new balance appearing on your personal consumer credit report can also be valuable. That can help a business owner avoid adding more utilization and inquiries and debt to their personal credit profile. But none of that makes the funding inexpensive. A soft pull can protect your personal credit report. It cannot protect your business cash flow from a bad financing decision. Now, does that mean that Revolut is automatically bad? Of course not. That's not what I'm saying at all, right? Funding can be expensive and still make sense in the right situation. So let's say you're operating a business where a customer owes you $60,000, but that customer takes 90 days to pay you. Your employees still have to be paid. Your rent still needs to be paid. You still need materials. You still need fuel for your vehicles. The business does not get to pause for 3 months just because one customer is slow. In that situation, a flex line could help bridge that temporary gap between completing the work and receiving the customer's payment. Or maybe you have an inventory opportunity where you know exactly what you can buy the inventory for, what you can sell it for, and approximately how long the sale will take. Or you have an established marketing campaign where every dollar that you put in has historically produced a predictable amount of revenue. Those are situations where more expensive short term funding may still create more value than it costs. But the key is really the use of the money needs to be intentional. You should already know what that money is going to be used for before you accept it. You should understand how quickly that use is expected to produce a revenue. You should calculate the total repayment, and you should make sure that, your normal cash flow can support the withdrawals even if the plan doesn't work perfectly. Because this is probably not the product that you want to use when your business is already struggling just to survive. So if your revenue is dropping, the bank account is constantly, going negative, your margins are already extremely thin, or you're using new funding to repay old funding, then adding daily or frequent withdrawals could make the situation worse very quickly. You also should not accept an offer simply because it does not require a hard pull. And I see people do this all the time. They become so focused, so laser focused on protecting their personal credit score that they stop evaluating whether the actual financing terms make sense. No hard inquiry does not automatically mean it's a good product for your business. No personal guarantee does not automatically mean the money is affordable. And a large approval does not automatically mean that you should use the full amount. Personally, one of the things I like about revenue is that it can help separate certain business expenses from your personal credit profile. In my own case, I completed the process, I received the approval, and I did not receive a hard inquiry on my personal credit. I also didn't have to worry about any balances being reported on my personal credit cards and increasing my personal utilization. I like the fact that the underwriting is focused more on the business. I even like having, access to both the Visa business card and the ability to request a cash draw. Oh, and I like the fast decision process and the access to an account manager too. And I like that the product may create an option for an established business owner whose personal credit is preventing them from qualifying, with a traditional bank. But the factor rate and the repayment frequency are two things I would examine, extremely carefully, because those two numbers can turn what looks like flexible business funding into a serious cash flow obligation. So, yes, I believe it's possible to get approved for revenue with bad personal credit. Revenue explicitly says it looks beyond the owner's credit score, and it has published customer stories involving business owners whose personal credit has been damaged. But bad credit is not the same thing as no qualifications. You still need a real business. You still need consistent revenue. You still need an established business bank account, and you still need enough cash flow to support the repayment structure. That $500,000 number is an advertised maximum, not an amount that the average, person should automatically expect. My own starting approval was $5,000. Another business owner I know received about $40,000. Your actual amount could be higher or lower depending on the strength and the revenue of your business. And before you accept any amount, make sure that you know four things, right? What's the factor rate? What is the total dollar amount I have to repay? How frequently will the payments be drawn? And can my business comfortably handle those payments without depending on everything going perfectly? Now, if your personal credit has been holding your business back, but your business has been operating for at least a year, you have a separate business checking account, and you're consistently depositing at least $20,000 per month, I'll leave a link below where you can check your eligibility. Applying will not affect your FICO score, but make sure you review your individual offer carefully before accepting anything. Because the real goal is not just to get approved for business funding. The true goal is to use the funding that actually leaves your business in a stronger position after it has been repaid. Thank you for watching.